Hey everybody, welcome to Capital Assets, our next topic. It's a big juicy one. The one after this, I'm going to probably jump to equity because it's the next probably most important. That distinguishes, it's like corporations, the equity section is very different. So we need to kind of get that done in case you go on and take accounting again someday. And then we'll try and fit in whatever we can. But this one's a little bit juicy, and it's also important if you're someone that has decided they want to do either accounting or is interested in investments, analyzing companies, whatever, because it's such a significant portion of a company's wealth and equity, right, is asset value, particularly the long-term or capital asset value. So they have very different names: capital assets, a lot of different ones, fixed assets, property, plant, and equipment, non-current assets. They all mean the same thing. They're your long-lasting, long-lived assets that you use to generate basically your revenue, to do whatever it is you're in business to do. So what I'm going to do is I'm going to go through the slides and I'm going to say which ones to focus on, which not, because remember, we're focusing this semester. And then I'm going to tell you which exercises you can try and which you could probably leave alone or do if you're still confused. I'm going to guess that when we get to the second part, actually, pause. Let's start again. Don't watch this video all at once, right? It's broken into parts on purpose. So watch this part, then try that activity, then go on to the next part and try the activities associated with that. You will see stop signs in this background, this slideshow. And if you're not sure where to get that slideshow, let me show you. So in our syllabus up here, under capital assets, you see right to the left of it, it says lesson with the link. So if you didn't know, that's where our slideshows are. That's the slideshow, this one here. And then I'm going through right now. I believe it works properly, but we'll find out. So the first thing we're going to talk about is essentially review. Most of it we can skip right through. So I just said this, but there are two types. So before we're done this topic, understand we're going to learn about, we're going to add lots of new information about the types of assets, which are tangible ones you can touch. And then the intangible ones we're going to introduce and talk about, which you've never had in grade 11, which are the like copyrights, patents, research and development costs, what else? Stuff like that, goodwill. I should also make a note, because I can't remember if I did already, is that one, you're going to hear my children in this because they're a little bonkers today. Apologize in advance. They might destroy the entire video process, in fact. And second, this is also a really important topic because it affects your equity value and all your ratios. Well, not all of them, but a lot of your ratios, right? So that if your valuation of your assets are off and they need to be reduced, your liabilities will stay the same. So your equity is going to be affected, the wealth of the business. And it's also going to change then any ratio that has a long-term asset in it, right? So this wonderful skip, don't focus. This is essentially what you have to remember with assets. This is all true. This is what really matters. So out of this whole section, here's what you need to remember. One, that an asset is anything that will provide a future benefit to the business. And second, the cost of an asset, as it says up here, is two things. One, the cost necessary to acquire the asset, and two, second part, to get it ready for its intended use. So if you're ordering a big piece of equipment from another country, it would include the cost of the equipment, the cost of any taxes, import duties, transportation, insurance en route, any customs duties crossing the border, installation fees, inspection fees by whatever government agency, safety person that needs to come in, electrician to wire it up. All of that would become part of the cost of the asset, right? And then there's situations where you spend money on something to improve that asset, and it actually becomes part of the asset, which is kind of new. So to keep it straight, just remember, if you spent money on something that will provide a future benefit to the business, in other words, that wealth that you spent is not fully consumed, then it's going to be what's called capitalized. It's going to become part of an asset value somewhere, right? So in other words, spending money on gas or salaries, you can't hold on to someone's labor. Same with electricity. But if you buy a vehicle, you still have the vehicle. So it's an asset. It's that concept. And the new addition is really just any cost associated with getting it and getting it ready, acquiring it and getting it ready for its intended use, right? So in this topic, well, same thing. We're going to talk about acquisition. We'll talk about adjusting values as time goes on. And then we might do a little bit on disposal. Okay. So next, if you know that, that's really the most important thing. The rest are examples. So if you can't settle on a price, you have to figure out what is the fair market value of the asset acquired or given up. So if it's a barter. But it's the same idea, right? By the way, if you're playing this, anywhere that this German word Achtung appears is a spot where there's a human judgment call. That there isn't actually an objective black and white receipt that says how much a transaction is for. It's somewhere where a human had to go, yeah, this much. Okay, which just goes to show you how much of asset value, how many accounting numbers are really just kind of, they could go a little this way or a little that way. They're just kind of fudged a little bit. So this is just an example, right? So if you buy land and you prove it, yeah, parking lots, fences and stuff, all that becomes part of the value of the land. Same building example. You can skip all these. The next thing that matters, and what we'll do first, is a little bit of review of amortization. So now we're on to valuation, right? Adjusting as time goes on. We're going to add a new one. So the activity at the end of this section is going to be review straight line. We're going to review declining balance, new little addition to declining balance, and this new one, units of activity. Units of activity is largely for, for any asset that you can track the units that you're using. So hours use of a machine or barrels of oil you take out of an oil well, right? It's often used with natural resources. This should be review. If you don't remember why you do amortization, you can read this as easily as I can. So let's move on to the next slide. There's a big Achtung there, of course, because you can pick what amortization method you want. And if you decide that your asset is wearing out slower or faster, you can also change the speed of amortization, which we're also going to learn about in grade 12. But first, on to our methods. So there's straight line, which produces the same expense every year, and declining balance, which produces this sort of slope, being higher level of amortization expense early and then it reduces. And then units of activity, which can be all over the place depending on how much you use the asset. All right. So if you recall straight line, the formula is you simply take your historical cost, you subtract away the salvage value because you don't want that to be amortized. And the numerator up top that you're left with is the value to be amortized. That is an important number to calculate in all methods, because when we come back to this, when in the next section of this topic, when we figure out how to adjust amortization, you need that number all the time. Anytime there's an adjustment. So you have to know how much value is left to be amortized. And that's the number you work with. You don't go through the whole formula necessarily from scratch from the beginning. Okay? So this historical cost minus salvage is the value to be amortized. It's divided by the useful life. So the years over which it will be amortized. And this is very much a units of activity formula. Just got a different name, really. Right? And remember, this gives you the
annual rate of amortization. So if it's for a month or a quarter, 3 months, you have to, what's called prorate it. You have to take the right
proportion. Don't forget. It's called straight line because if you graphed it, it looks like the straight line. Right? So you should use it with either something that's too complicated to use in any other method, because it's pretty easy, or 2, something that wears out fairly evenly over its useful life. Okay, declining balance. You take the book value. And if you don't know what book value is, that's one of the most important concepts in accounting. That is your accounting value assigned to that item. So for account receivable, the book value of accounts receivable is what's owed to you legally minus the allowance for bad debt. Right? So the book value of an asset is its cost, original cost, minus all amortization or depreciation to date. So that book value is what you multiply the declining balance rate. So the annual rate at which the book value wears out. So if it's 10%, whatever the book value at the start of the year is, 10% of that will become that year's amortization expense. Again, it's an annual. The formula gives you an annual expense. So this should still be a review. This is new. So sometimes you have an idea that an asset will last for 10 years, or maybe the warranties for 10 years. So you say, but you're not going to use straight line. So sometimes what you'll read both in the textbook and you'll encounter in life is that companies will use what's called the declining the straight line rate or double the straight line rate. And what it means is if you take 100% and you divide it by the useful life, so if you think it's going to last 10 years, as the example on the bottom goes, then the declining balance rate for the formula would be 10%. So in other words, it's called the straight line rate because you're taking the straight line years of useful life in the denominator there. Does that make sense? Okay. So, and if it says double the straight line rate, it means take that answer, 10%, and double it. It's almost not even worth having a slide for. Anyway, and again, it's downward sloping. So you should pick it for things that were earlier, like disproportionately earlier in their useful life. So this is new. So units of activity. There's 2 steps. The first is to figure out what is the amortization cost per unit. And the next step is then to apply it. So up here you see you've got total cost of the resource minus salvage value over the total units available. So that first equation should look a lot like this straight line calculation because it is. It's the same. So you take the cost, you remove salvage if there is any, and that's the value to be amortized over the useful life. In this case, it's life units of life. So hours of machining, kilometers of travel, barrels of oil in an oil well, number of, I don't know, tons of ore in an ore mine, whatever, right? That'll give you the cost of amortization per unit, whether it's per ton, per hour, whatever. The second step down below is then to apply it. So if once you have that amortization cost per unit, you then multiply it by however many units were used, consumed during the accounting period, and that gives you your expense for that period. Make sense? If not, get in touch. So here's an example. Since this is the new one, we'll do an example. It's in the slideshow. So let's say you have a mine. It's got 1 million cubic meters of ore. So the cost of finding this particular vein of ore, dropping a shaft, preparing it for use is $50 million. Okay, so this year we harvested or yanked out 75,000 cubic meters of ore from the mine. So what's our amortization expense? So the mine's worth 50 million, units available 1 million. So this is the first equation. It's like straight line. Doesn't say there's any scrap value or salvage value, so it's just $50 million divided by 1 million units. So the amortization cost is $50 per cubic meter of ore. The amortization expense, well, it's just simply 75,000 cubic meters extracted times $50 per unit. And then you get this sort of random, depends on however many units you pull out of the mine, right? So you'll have a sort of an erratic shape to your amortization expense over time, sometimes. Make sense? Okay, there's 2 problems. The first one's mostly review. It's got a straight line bit in there too, but what I want you to focus on when you're done is this bit in 7. And I'll tell you what the bit is so that when you get to it, you see it. Again, the solutions are already there on the syllabus. Think about this. When you say you spend $1 million for a machine, and then when it's done, you dispose of it you only get $100,000 for it, right? How much you out? $900,000, right? Spend $1 million, you get $100,000 back when you sell it off to some other company, right? And you're done with it. You're out $900,000. Period. Doesn't matter what amortization method you picked. Doesn't matter how fast you amortize it, how slow. Doesn't Doesn't matter if you sold it for a capital gain or a capital loss. All of that is accounting paperwork. And to the end of the day, you bought it for $1 million, you disposed of it for $100,000, you lost $900,000 on the machine. Period. So think about that when you do 7A, particularly that Part B. And when you look at the solution set, you'll see that the loss is the same, but what you call, how you break it down into amortization expense versus gain or loss on disposal. All right, so stop this, try those before you go on with this video, right? And those, just so you know, on the syllabus are right here. All you need to do first is just this row. So the next part in this big topic of capital assets is changing amortization. So in other words, once you acquire and you're adjusting as life goes on and disposing, you're here in the adjusting part. What happens if you've picked your amortization method, everything's rolling along, you realize, wow, this machine is going to last a lot longer than we thought. What do? Well, you change your amortization schedules, right? You change the speed of amortization. So this section is on how we do that and what's involved. This is essentially all you need to focus on. Why would you do this? Well, either two reasons. One, amortization is inadequate. It's too slow or too fast, right? The machine is wearing out at a different rate. And the second reason is that you made what's called an improvement to the asset, not a repair. So a repair maintains the asset doing what it was always meant to do. An improvement means it does something it never did before, or it does it in a way it never did it before, like much more efficiently or whatever, right? So improvements are capitalized, which means you add an improvement to the value of the asset, whereas a repair is just an expense. It affects the amortization and the asset value. It doesn't affect it, right, at all. An improvement does. So those are the two reasons. So this slide just explains what I just said. So ordinary repairs that maintain the asset doing what it was always meant to do are just expensed. But improvements are added to the value of the asset and will change annual amortization rates. So this is another Achtung again, because sometimes it's a judgment call. Was this an improvement or was it just a repair? Bit of this, bit of that. It's not always straightforward. So here's the thing. You can also, I'm not going to focus on this because it's a bit involved and we don't have that much time left. But if you do decide, wow, straight line just isn't right, we need to switch to units of activity, then what you have to do is go back and find out what all your expense would have been had you done it the new way all along. And the grand total of the difference between the old way and the new way for all previous years, that one amount, the grand total, gets charged right to your equity account. You don't change previous year's financial statements. You don't go back into the records, and you don't change this year's expense amount for all that difference from previous years. Instead, you just change the capital account directly. It's called a prior period adjustment. And you show it on the balance sheet, not the income statement, because it doesn't affect this year's performance. So there might be an exercise where that's in there. If you're interested in learning this stuff and you're continuing on, this will be probably a topic where you will need to share your files and ask some questions. And I don't mind. Okay? So on to how to do some of these exercises. To do the online exercises with changing amortization, I want to bring your attention to this concept one more time. You have to take the value left to be amortized, and then you would need to say, okay, we made an improvement. You need to add that new value, and then we're going to stretch the life by 15 years, and then recalculate. So taking all that into consideration, you need to know the value left to be amortized in the numerator and spread it out over the denominator, which is the useful life left at that time, not when the asset was brand new. Okay? So give that a crack. I feel you may need to ask questions. No problem. So the files for this second part are these first two. I may answer a lot of questions or I may make another video, but the first one, try it. I'll draw your attention to where people make some mistakes. It kind of looks like this. These are one of my old files. They're kind of crappier. I basically have to do all your calculations on the side and then just put in your final journal entries for what would happen. Why didn't that switch? Switch. Like this. So here's original values before adjustments. And then this is values after the 2015 adjustment and after the 2016 adjustment. So you got a couple of things that happen in chronological order. So for example, it purchases a well for $30 million. It tells you it's got 1 million barrels of oil. Salvage value of the land and the capital assets is 2.4 million. So you'd come up with and it's giving you the information for units of activity. So in the year 2015, it makes improvements. So you have a couple years before that, then you have improvements in this year, which means you will have already amortized 2 years worth. Then in 2015, you're making an improvement, right? In 2015, you're going to make improvements, and it adds additional barrels of oil, makes 3 million barrels of oil more accessible. So that's changing the numerator because of previous amortization, and in goes the improvement. And in the bottom, you've already taken out oil in 2013 and 2014. And in 2015, you now have 3 million more accessible. So both the numerator and the denominator change when you then recalculate what amortization should be per barrel of oil. Give it a crack. Don't feel bad if you need to share your file and ask me a question. All right? Hey, so last part. Not this part. So I made an executive decision to skip this because it's usually the hardest part. And we're running out of time. And it doesn't add that much understanding to capital assets. We are going to switch to the whole new category of capital assets, which are your intangible assets, the things you can't touch. That's what tangible means. They're things that can be very important, particularly to tech companies and companies that don't sell a physical product, right? So things like patents and research and development and all that sort of stuff. Trademarks, all these things, right? So some of these things, essentially legal rights. These legal rights, some of them have lives that are for a particular period of time, so a definite finite period of time. Those ones are amortized, and others could potentially last forever. One of them is goodwill. This is actually one of the most important parts of this topic for those of you that want to learn how to analyze a business, because they're so difficult to put a value on. There can be a lot of fluff in the section. There are some companies where goodwill is almost 80% of their entire asset value in total, and nothing exists for goodwill, as you'll see. So copyrights last for 50 years, the life of the creator, and then another 50 years, right? So they have a definite life. So you can amortize them. All intangible assets that can be amortized are amortized using straight line. Another one are things like trademark names, things that make your brand identity, right? They're important and they should be defended. Likewise, the value of something, for example, like a patent, if you have to expend legal fees and go to court to defend a patent, those legal fees actually become part of the cost of the patent and can be amortized over time as well instead of just all at once. I think it even says that up there. It does say that up there. Patents last for about 20 years. Depends on the country, but it's about 20 years, which means they will also be amortized over 20 years. And interesting, not in the slide, is that as you're you're trying to come up with a new drug, so coronavirus vaccine, all that research is an expense until you're at the point where you potentially have a viable drug. And again, this is a huge could go this way, could go that way, very fudgy when you're at that point. But for example, if you're in human trials with a drug that's safe enough to try with humans to get approval, you're probably at the stage where you're no longer researching, you are developing. And development costs are capitalized. Remember that word? It means they're added to the value of assets. And those development costs, so your research costs are expensed. And then when you cross over, you get into development costs, and they actually become, if it turns into a drug for which you get a patent, those development costs become the value of the patent. So at what point are your research costs not expenses, they're assets? Well, who knows, right? That's something you would want to consider. If you're looking at a drug company that has lots of research costs and no development costs, that gives you information. They're doing lots of research, which is great, but why is nothing turning into a product? Right? So that's how it works. You don't really need to know a lot about franchises and stuff, but goodwill, you should need to know what that is, because the word is very misleading on a balance sheet. You'll see it right there. It'll say goodwill, and often it can be very large. Goodwill only comes into existence when one company takes over another and pays more than the fair value of its assets. So in other words, when you take over a company, look at the fair market value of the assets when you take them over, and if you pay more than that, you end up with goodwill. It's essentially a balancing technique in the books. So some companies will have billions of dollars of goodwill for which there is nothing. There's no actual asset for that. Right? So all the assets they acquire, they go on the balance sheet too. But then because you paid more than what they are worth, you need to balance it somehow. So you create goodwill. And the only reason you would do that, of course, is because you think the company you're taking over is worth more than what the balance sheet tells you, than what the assets alone say. So they have good management. They got a great product. The patent is worth way more than it costs to develop it. The brand is terrific. So there's lots of companies that are worth more. Their market value and their future profit potential is worth more than just what their assets say they're worth, right? That are worth a lot more than just their accounting book value equity. So that's where goodwill comes from. But once you pay that, if it turns out you're wrong, that goodwill goes up in a poof of smoke. Poof. Just like that. Gone. Because there's nothing actual tangible anywhere in the business for that goodwill. Okay? So that's what this impairment bit is about. Goodwill has to be tested regularly for what's called impairment. In fact, all assets are. So impairment means if the fair market value of this is gone, then you can't keep that value. It's very much like a lower of cost or market write-down. So if the asset no longer is worth what you have it for at cost on your balance sheet, then it's impaired and you have to erase that value in a big write-down. Really smokes your profit number. So, and all of this is just fudge, made up. When the impairment happens, how much the impairment is, it's all guesswork. I mean, there's processes in place, but it's all just kind of pie in the sky. So here's an example of where it comes from. In this example, we're going to say firm A, I couldn't remember what my example was. Firm A is going to buy firm B. So firm A for $100,000. Okay? So here are the assets of firm A. They got $100,000 in cash, a bunch of other assets, and some liabilities and equity, right? And they're going to take that $100,000 of cash and they're going to acquire firm B. And firm B has $50,000 of cash, which they're going to get, and a few liabilities and other equity. Okay? So out it goes. Understand that firm A is not giving $100,000 to firm B. Firm A is giving $100,000 to the owners of firm B. So that $100,000 is leaving the new entity over here on my head of firm AB, the combined new entity after the takeover. So that $100,000 is gone. Okay? So firm AB, the new combined firm after the takeover, has only got $50,000 of cash, right? Because the 100 and the 50 would have been 150, but 100,000 left. Went to the shareholders of firm B because we, firm A, we bought firm B, so we paid the shareholders $100,000. So you'll have 50 left in the combined entity. $400,000 other assets and $25,000 of goodwill. Why? Well, take a look down at the equity of firm B. It was $75,000. Well, we paid $100,000 for a firm worth $75,000. That's where it came from, right? So $100,000 of cash minus the equity we acquired means we overpaid $25,000, and we didn't necessarily overpay. They might be worth it. It might be a really good company that we just need to get our hands on. A competitor, maybe even. Right? So otherwise, we'd have to show this as an expense, as a loss of $25,000. So that violates the concept of will provide a future benefit. So if we think this $100,000 we paid, including that $25,000 we paid above equity value, will provide a future benefit, then it needs to stay on the balance sheet. That's the philosophy. That's the thinking. So there we go. How does the rest combine? Well, the liabilities are still there. So it's a combined total of $275, but equity is different. It's only $200. It has to be to balance, but mathematically, where does it come from? The combined equity of the two firms would have been $275, but we pay $100,000 left to pay the shareholders of firm B, and we retained $25,000. We invented $25,000 of value in goodwill, and that works out to be $200,000 of equity. Make sense? That's where it comes from. So as you can see, the assets, the real assets, are $400,000. The goodwill is made up. So if it's impaired, firm B didn't pan out the way we thought it was going to be taking it over, then that $25,000 is going to just disappear in an impairment charge 1 year. That's how it works. So if you see a lot of goodwill, just be wary. So this is the impairment test. You can read this on your own, but things that would, result in that you want to consider when you think about impairment, things like, if you took over firm B because they had lots of smart people inventing new things, and then all of those people leave and start their own company, right? So stuff like that you would consider, is our goodwill impaired? Do we need to erase it? Okay, R&D costs. Already, I can just spit on the table. Wow, that was quite a... How about that? Research and development costs. So as I said this already in this video, but research costs are expenses. Development costs are capitalized, so they're added to an asset's value. And when the split happens, when you have an identifiable and feasible product, for an actual, a product like when you can touch like a phone or something, you have to have a prototype, right? But for drugs and other things, it can be not black and white. It's very gray. So, intangible assets is essentially the same accounting, like amortizing them, except you don't amortize land because it lasts forever, because it has an indefinite life. Same applies with intangible assets. If they have an indefinite life, potentially, like goodwill, you don't amortize them, right? Trademarks, same thing. Copyright, you do amortize because it has a definite life. A patent, you do amortize straight line because it has a definite life of 20 years or whatever. So it's a straight line method with no scrap value, and that's it. Check out those problems. Let me know if you have any questions.